Shocks, poverty, and the impact of financial protection. When I think about shocks, the shock that immediately came into my head was the Ebola crisis. And when I was reflecting on this, I was thinking, why was it the Ebola crisis that was the first event that I thought about? It had a devastating impact on poverty outcomes in the countries that it affected. It disrupted communities, etc. But when I thought a bit more, the reason why it came into my head is because it was a crisis that was avoidable. Ebola, by its nature, is an infectious disease. And so if you can react early, respond early, stop the outbreak from happening, you can prevent it turning into a catastrophe. As we all know, this didn't happen. So in the 3 countries in West Africa where the disease broke out, numbers spiraled out of control. The WHO, to their credit, did an investigation. They wanted to understand what went wrong. How can we improve how we respond to shocks like this? And they conducted a report called the Stockings Report, which had 3 key findings. Finding number 1, there was no contingency financing in place. They had no money to respond. Number 2, there was contingency plans, but they had no teeth. They weren't acted upon. And number 3, there was no coordination between the response actors. Now, you're probably wondering, Barry, what are you doing up there talking about Ebola? This is about disasters. And the reason I'm talking about it is because the inaction in the case of Ebola applies equally to natural disasters, and similarly, disasters can turn into catastrophes. John Rue made this point, so I'm just going to stand here now for a few seconds. Shocks drive people into poverty. Climate change is getting worse. So thank you, John, for that. I appreciate it. And the area which I work in is the area of financial protection. It's a growing area. It's a very exciting area. But one of the, I suppose, pitfalls is that we don't really understand the relationship between financial protection and poverty outcomes until now. And before I get there, let me just take a step back. So what is financial protection? So financial protection disaster risk financing is about building the financial resilience of governments, communities, and businesses against the impact of disaster events. And with the advancements in understanding risks, we can now actually understand the links between financial protection and poverty. There's been huge advancements in hazard models in recent years. Previously, it cost $1 million to get one. Now you can get one that's as effective for much cheaper. There's also been huge advancements in actually understanding the exposure, understanding where poor people are. And so with these 2 events, the risk modelers among you know what's coming next. It's, of course, the vulnerability modules. And this is what this area of research focused on. If a disaster happens, what is the impact on poor and vulnerable households? What is that link? And so we obviously mixed all these 3 modules together. Again, risk modelers know this much better than I do. And the results that we found were kind of intuitive, what we thought they would be. It is that financial protection does make a difference. It's not only about insurance, it's about having clear decision-making processes, but having plans with teeth, and also having financing on standby. So, there you are, Barry, telling me disaster risk financing is great, and here I am, a disaster risk financing expert. How convenient. Well, I can actually tell you we have proof to back up this claim. I have 3 examples. Example number 1 comes from Ethiopia. So in Ethiopia, with their productive safety net, when it responded in advance of a drought, it reduced the impact on the household by 25%. 25% is a big number, so we put it in a big font. Example number 2, in Mexico. With fondant in place, they were able to implement their reconstruction program rapidly. This led to an increase in economic activity in the local area by between 2 and 4%. Example number 3, in Jamaica. Insurance was found to be 3 times less expensive than how they usually pay for disaster response. So you may be sitting there saying, yeah, Barry, you haven't really convinced me that disaster risk financing or financial protection is the way to go. However, that wasn't my objective here today. My objective was to give you guys an insight, give you guys a little bit of information, maybe raise some eyebrows, rattle some cages. The people who are going to convince you that disaster risk financing and financial protection can impact poverty outcomes are the people on this slide. So I encourage you all now to take out your phones. We have the heavyweights coming in on Friday to present to you in much more detail the results of this analysis. So again, I encourage you all to take out your phones, take a picture. Don't take a picture of me, take a picture of the slide. Friday, 2 to 3:30 in the Cape Town room. Come join us for this discussion about disaster risk financing and how it can impact poverty outcomes. Thank you very much.